Hello, everyone, and welcome back to the ZenB podcast. I'm Bianca Procter, and I'm here with a very special guest.
Hey everyone, Omar Diaz. I'm a mortgage lender. Been in the industry for a little bit over 5 years now. Happy to be here. Thank you for having me, Bianca.
Of course, thank you for coming on. So, I wanted to bring him on because since I've gotten more into real estate, I've learned a lot about the intricacies and all the moving parts that are in the business. And I'm sure if I have a lot of questions, especially as a first-time home buyer, there are definitely people out there that have a lot of questions as well. So, let's jump right into it. What are the basic loans that new homeowners should know about?
All right. So there's definitely, a lot of loan types, that we can get into. But we should get right to the basics. You either get into a conventional loan, there's FHA loans or special program. Mortgage loans, they're organized into categories based on the size of the loan or whether or not, they're part of a government program. You'll need to know, how much, you'll need for a down payment, the total cost of your loan, including the interest or mortgage insurance, and how much money you can borrow, and the price range on the house that you can consider. So each loan type, is designed for different situations. Sometimes only one loan type will fit into your situation. If multiple options for your situation, you can try out different scenarios. Speak to lenders and find out which one's going to give you the best deal overall. So the majority of buyers, they'll fall into a category of conventional loans. So this typically it's going to cost a little less than FHA when it comes to mortgage insurance. It's a little bit harder to get because you do need a better credit score than an FHA loan, but it is the majority of the loans that are done today. And then you have your FHA loans, which you can come in with a lower down payment, and it's available to people with lower credit scores and also with lower income because the debt to income ratios are a little bit higher. There's also special programs that are government guaranteed, which is, your VA loans for veterans or spouses of veterans, and your USDA loans. So both those loans you can actually get in with a 0% down, and that's going to depend on whether you fit into that category. So for, like I said before, a VA loan, you need to be a veteran or a spouse of a deceased veteran, or a veteran that's stationed overseas. And for USDA loan, that'll depend on where the home is located. So if you're in a rural area in the United States, with a very low population count, the government has a program for that, for you to be able to buy a home there.
Okay, so just to recap, from my understanding, you have the conventional loans, the FHA loans, the VA loans, and the USDA loans. Like those are the four main type of loans that you'll find, especially like as a first-time home buyer. The conventional loans are for the people that have a little bit better of a credit score, and you said that it is a little more expensive every month.
It's a little pricier because you'll need to go with a higher down payment, sometimes a 5% down, maybe even a 20% down, depending on the type of property. As a first time buyer, you can go in with 3% down. You'll need to take a home ownership course. It's only a couple of hours, but you can take advantage of the 3% down if you haven't owned a home in the last 3 years.
So, what is the benefit of putting more of a down payment?
So you lower your monthly payment, and it'll bring you just that step closer to getting rid of your mortgage insurance. So with a conventional loan, you'll have mortgage insurance until you have about 20% equity on your home, right? So that mortgage insurance, can definitely be a couple of $100s a month, So if you put a 20% down, you won't have to pay that mortgage insurance. If you put less than 20, you'll have to pay.
And then you said the FHA loans are for people that have a little bit lower of a credit score and lower of an income.
Right. So the FHA loan is, most people think it's a first-time home buyer program or something. It's actually the Federal Housing Administration, right?
Okay.
So this loan, first-time buyers can take advantage of it because you can come in with a 3.5% down, and if you have less than perfect credit, then you can also buy the home. But anyone can use it, as long as you don't have another FHA loan you can purchase a home with FHA. It just has to be your primary. That debt to income ratio can go up to 56.9% versus a conventional loan where you can go up to 50 depending on certain, scenarios. But it's a lot easier, to qualify for a conventional loan because there's less restrictions and it's not a government insured loan like FHA is.
So if you, let's say, if you have a good credit score, if you have a good like income, you can't apply for an FHA loan. Like you would only really be qualified for a conventional loan.
So if you can qualify for a conventional loan,
Yeah.
you definitely can you can qualify for an FHA, right? If you qualify for an FHA, it doesn't necessarily mean you can qualify for conventional,
Mhm.
they're because of the credit score limits. But it all depends on the situation. If you have the credit score, but you don't have the income, to meet that the income ratio, that threshold for conventional, well, sometimes I'll recommend people to go FHA if they need that little room on the debt to income ratio.
Okay. And then you said the VA loan is for veterans, people that are married to a veteran or have a deceased, married to a, like widowed.
Right.
And then USDA loan is for more of like the rural areas.
Exactly. You go out into the country, you want to have a farm and, in the middle of nowhere, that USDA is perfect for that. And the veterans, we have the VA loan, the special program out there. Like I've done loans for veterans where they've been able to pair it up with a seller credit. So the veteran doesn't have to pay any down payments or 0% down, and the seller has actually paid the closing costs. So I've had veterans buy a home with zero money out of pocket,
Wow.
other than the appraisal.
So what is like the process? What are the steps? What are the things that kind of come up that you notice a lot?
So the first step, when you to work with a mortgage lender, first, find a mortgage lender that you feel comfortable with, that works with your realtor, that's part of the realtor's team, because there's already some communication built there. So, definitely find somebody that you're comfortable with, somebody that your realtor's comfortable with. But once you have your mortgage lender, the first thing to do is, get pre-approved. Before you even start looking for a home, you need to get pre-approved. That way you know what your buying power is. So, certainly, how much you can afford to pay. The lender will speak to you about the different types of mortgages that you qualify for and, which one's right for you. They'll go over, how much down payment you need to pay, if you're going to pay any mortgage insurance. There's a lot of things that, exactly how much you're going to be able to afford. That way you're not out there looking for a home that you don't actually afford.
Mm.
Once you have your pre-approval, your lender's going to send that over to your realtor, and your realtor's going to have that discussion with you. What I'm saying, now this is what you can afford. Based on your criteria, you go out there and you find a property. So you find a property. Once you find a property and you put that on the contract with the pre-approval that your lender gives you, and with the pre-approval, you present that with your offer to let them know that you've already been vetted and qualified for a mortgage. Once we receive that contract, then it comes in the application part. We've already, to do the pre-approval, you've already sent in, your proof of your assets. We'll check your credit. We'll check the proof of income and your employment. And once we apply for the mortgage, we submit that over, with the disclosures and send that over to processing. That's when they're going to start verifying your employer. We'll start going back, if we need to order taxes, or tax transcripts, that'll get done. We'll go over all your debts, everything on your credit, the property information. Those are things that need to be looked over prior to send it over to processing. That way you can have a smooth process. You don't want to start asking too many questions later on.
Mm-hmm.
Once your loan is in processing, the processor is going to verify your employer. They're going to verify certain things with the title company, with just any issues, with any liens on the property. They'll order a survey. They're going to order an appraisal. You at the same time prior to ordering the appraisal, you'll also order an inspection on the property. Right? Once we receive that, once processing has looked at the file and it's already been disclosed, we've verified the income, all that paperwork, the assets, your bank statement, is going to be sent over to the underwriter to review everything. They're going to review the contract, they'll review the appraisal of his comeback. They're going to look at it and see if there's any other conditions that some conditions can be, we'll need to do deeper verifications on the employer, if you have any overtime, if there's any questions, regarding the amount of hours that you work. The underwriter is going to want to address those things. They'll look at your bank statements to see, if you've properly seasoned the funds for closing, or if there's any gifts. If there's any gifts, they'll have to have some letters, sent in. The underwriter is going to want to verify all of that, So if they have any questions, they'll send back to the processor a list of conditions. They'll approve the loan conditionally, and it's up to the processor, the loan officer, and the buyer, to gather all those conditions as quick as possible to send it back to underwrite. So once the underwriter verifies all the conditions, so if, like I said, let's say something comes up in your pay stub, there's a question as to why did you work less hours, this week or anything. The underwriter wants to verify to make sure that we've calculated income correctly. If they ask for a letter from your employer, that can be a condition, like, hey, explain the hours and please verify that this employer is works 40 hours employee works 40 hours per week. The underwriter can actually put that as a condition. We'll take that, we'll clarify that condition, send any letters that the underwriter asks for. Mm-hmm. Once we clear that and there's no other conditions, then we'll get to clear the close. Like, hey, we're good. Let's start prepping with the title company, get the final numbers so they can close. So normally we'll try to get these conditions, like we'll do like a one touch or two touch. On our world, that means how many times do we send it back to underwriting, so they can clear any conditions that we have. So the more paperwork that we gather up front, the more your loan officer knows and understands, the mortgage process, the less times we'll have to send the file back to underwriting to get it cleared.
Also, I do want to go into a little bit people that are self-employed.
So for self-employed borrowers, it gets tricky there, when we start looking into it, because there's a little bit more information that we need to verify. Mm-hmm. So a self-employed, so like we'll go a W-2 employee, someone that works for a company, they get a paycheck every week and the taxes are taken out, from the company. A self-employed borrower, someone that they either get paid by 1099 or they have their own business, either a corporation or an LLC, mm-hmm. and they pay themselves. So the rule of thumb is, if you're self-employed, the banks wants to see a history of you earning money through your own company or as a self-employed person. So we'll check the last 2 years of your taxes, of your income taxes. Mm-hmm. And so for FHA and conventional, we'll have to average out your net income from your taxes. Mm-hmm. So what happens is, a lot of people, they'll say, oh, I'm self-employed, I made $200,000 this year, but then they'll put $150,000 in expenses. So your net income is only $50,000, and you're saying, no, but I made so much money last year. Well, technically, you didn't let the IRS know that you made that much money. Mm-hmm. So that's why we need to go back 2 years and verify. There are certain things that can be excluded from the expenses that you put on your taxes. We can go over that, but this podcast will take 2 hours. So
yeah, let's save it for another time.
So we can go back and do another video or something on on how can we exclude certain expenses.
Okay, right? Yeah.
Self-employed. Yeah. So normally 2 years. Now with Freddie Mac, if you show that you've been in business for over 5 years, and you have the credit score, to be able to do a conventional loan, we can go with Freddie Mac and actually do the loan with 1 year taxes. Okay. So let's say you did very well in 2021 and you made $200,000 and you did not have many expenses. So your net income was, let's say it was $150,000. We can use that $150,000, to qualify with Freddie Mac 1 year taxes. If we go Fannie Mae, Freddie Mac, or FHA using 2 years taxes, we'll have to take the average from 2020 and 2021.
So it sounds like it's a lengthy process in and of itself. How long would you say for someone to kind of plan out to do this process?
So normally, most banks try to stay within the 30 days, that's on the contract. There's a process for the approval period.
Hmm.
Many realtors, they'll work with the loan officer. Hey, how much time do you think we need to get the loan conditionally approved? That means getting the appraisal back and getting the underwriter to take that first look at the loan and give us a conditional approval. A lot of people put 20, 21 days. I've worked with banks, that can close a loan in 10 to 15 days. It's all gonna matter, whether, how good of a team your loan officer has, how fast the processes work, how clean was the file when we first received it. So, did your loan officer ask the right questions? When we receive the pay stubs, the bank statements, once we look at your credit, your loan officer has to ask the right questions to be able to battle those conditions up front and send a complete package. So if your loan officer does that up front and clears everything, you can have a very quick closing, let's say 15, 20 days. Most of the time, they'll try to stay within 30.
Hmm.
There are things that can happen, if you have any issues with title, if there's paperwork that's not coming back soon enough, it might take a little longer. But those are special times, where there's things that are out of your control.
Wow, that's so fast. I thought that it was like you needed to plan like 3, 4 months in advance to get pre-approved and look for a house and then get a
No,
mortgage.
the pre-approval, if your loan officer should be able to get your pre-approval back within 24 hours of you sending all the paperwork,
Mm.
right? So, like I said, it's all about asking the right questions and gathering everything up front. So, in my case, if I get a paperwork, 10 o'clock in the morning, I'll try to have it back within a couple of hours. Once I have all the information that I need, it's a quick way to make it happen. As long as we have all the information.
So, what would you say are like the top misconceptions that you see with new homeowners? Because for me, at least, I see a lot of hesitancy and fear.
So, top misconceptions, I would say the first one would be people are afraid that they need a lot of money to purchase a home. Like, hey, I need 20% down to buy a home. And that's not true. As a first time buyer with a conventional loan, you can buy a home with as little as 3% down with a conventional. Go FHA is 3.5% down. A VA is 0% down. USDA is 0% down. So it's not that difficult. You don't need a lot of money to buy a home. Once you start getting into the higher 20% down, 15%, you're looking at investment, type of deals.
Hmm.
But if you don't want to pay PMI,
What is PMI?
do mortgage insurance.
Oh.
So it's an insurance that covers the bank. Let's say were you to default on your loan, it's an insurance, that you pay, to make sure that lets the bank know, like, hey, what, if they default, we're going to cover your losses. So,
Okay. And then is there any other misconceptions that you see?
um, misconceptions, trying to find a home before you are even pre-qualified.
Yeah.
That's, I've had cases where, I have someone go on the computer and they'll find a mortgage calculator, and the mortgage calculator will tell them, oh, you qualify for so much, you can buy a $500,000 home. Then they'll come to me and I'll say, hey, let's get qualified first. And they only qualify for a $400,000 home. So they've wasted a lot of time. They've gotten excited, on a home that, hey, I can buy a house, brand new, with all the, bells and whistles, where they can qualify for something, you know, not so nice, or not in that price range. So it's bad to fall in love with a house that you can't afford, you know.
Yeah, I feel like it almost breaks your heart in a way. What are the top 5 things that every new homeowner should know? Top 3 to 5 things.
Top 3 to 5 things. I mean, I'd say to get prepared at least, start working on, paying off debt, get rid of any like high credit card balances, start paying those down, try to stay, under the 30% usage so you can raise your credit score. To save for your down payment, save for your deposit or for your closing costs as well. Um, Choose a loan officer that you're comfortable working with and that your realtor is comfortable working with. You know, the worst thing you can do getting into this process is having, you know, having miscommunication. You know, that can really make a deal go sideways. And lastly, you know, the right time to buy is when you're ready. It's not what the market is telling you that you're ready.
Mm.
You know, so the market can say, you know, in 2020, everyone was saying, oh, the market's going to crash. And now people wish they bought in 2020, you know. So whenever you're ready, that's the perfect time to buy.
Right. And then last question, this is a bonus question. Um, what should people look for with a mortgage loan officer?
I would say find a loan officer that's willing to educate you through the process. You know, if you have a loan officer that's cut and dry, you know, I need this, and that, and leaves you with all the questions in your head, you know, you might not want to work with that person. This process is very exciting. It's a very good process to go through because you're buying your home. You know, at the end of the day, you know, it should be pleasing. You know, it should be fun. It should be exciting. So find a loan officer that's going to walk you through, explain everything, answer your phone calls. You know, someone that's going to be, you know, it's going to be Saturday night at 7 o'clock at night. You want a loan officer that's going to answer the phone, right? To you and to your realtor. So I would say someone that's comfortable, that you're comfortable working with, that your realtor's comfortable working with, and that's gonna basically hold your hand through the process.
Awesome. Thank you. I will say that every time I've called you, you picked up the phone or like called me within like 5 minutes. So I
Right.
can attest to that like you're really, really good about like making sure that you call people back. How can people work with you?
So you can call me 786-805-5252. You can find me on Instagram at Omar Diaz Mortgage. Uh, yeah, basically reach out. You know, you can text or call. You know, that's a good way to get a hold of me. And yeah, I'll be happy to help.
Is there any last words that you have to the first time home buyers?
I cannot stress it enough. Get pre-qualified before you buy. Get pre-qualified before you start looking. Get pre-qualified. Ask questions. You know, try to get as much clarity as you can. I always say people are afraid of what they don't understand. You know, so it's supposed to be a very exciting process. So ask questions and feel comfortable the whole way through.
Well, thank you, Omar, so much for coming on the podcast and taking the time to talk with us. We will definitely have a second episode, but this episode was absolutely amazing and so full of information for people that are first-time home buyers. So thank you so, so much.
Thank you for having me.